My name is Michael Guyette, publisher of the Lead Lag Report. Joining me there is Terrence Brogan, who's got a lot of interesting family history when it comes to markets. Terrence, introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in markets, and what are you doing currently?
Absolutely. Well, thanks for having me. This is a great pleasure. And as you said, I'm part of a family business, which, it's very interesting, never a dull moment. I joined my father in '02. I got licensed in the markets in '99, right out of college. And was kind of at the kitchen table, early on in life, watching my father do charts and, drawing trend lines on charts, never realizing that I'd be following in his footsteps. But like a great son, I, always look up to my father and loved what he did and what he, currently is doing today. So, yeah, I joined him in '02, and we really specialize in money flow analysis. And his curriculum vitae is really my curriculum vitae, because it's really almost, the only thing I've done in the financial markets is work with my father and my brothers and do money flow analysis. So it's, a family business. There's only, there's one way in, one way out. You're married to the family. But the history is really interesting because I didn't know what I was getting into at the time. And growing up, not really kind of oblivious to what my father was doing. But it was really cutting edge, as I find out later on in life. And it got my CMT designation in '08, and actually read about my father and his former partner, Mark Chaikin, in what they did in history. And it's, really, I've become a student of history. As technical analysis, we learn about all the greats that have come before us. And as they say, I think Ralph Ankaporis says, or many say, we stand on the shoulders of the great ones that have come before us. And that's really what I do. I use work that has been done before me and try to make it a little bit better if I can with technology. And so really the history of our family starts with my father. He came into the business in 1968 at Dean Witter. It kind of reminds me of the movie with, I already forget it. But it's a great story. He basically had young kids and was trying to make a buck and loved the stock market. He joined Dean Witter, and they had a guy by the name of Dr. Levy had a software program called Compare, Computer Assisted Research. And it really was the beginning of, I would say, technical analysis back then, at least his first introduction to it. And Dr. Levy did a great white paper on relative strength. I think the primary working of relative strength. And Charles Kirkpatrick, who's well known in the CMT, worked with Dr. Levy. And my father got this software. It really was a weekend delivery. And it was a relative strength kind of moving average momentum model that my father used to do stock selection. And that really was his first introduction into using technical analysis. He was always looking for something that would give him an edge to identify stocks that would go up and make money. And so with that, he would study the markets and identify. He really used the utility sector, ended up being a great winner for him during his early part of his career. And then he went on to Wertheim and was doing some, so he was an institutional sales guy, trying to work his way up to where the money was, from the retail side to the institutional side, and worked in the energy, providing fundamental research on the energy side. And he overlaid the Compare model with that. And then he had the opportunity to open Tucker Anthony in Philadelphia in the '80s. And they had the great guru at the time, or at least was one of them. It was Stan Burge. And Stan Burge is the most well-known, not well-known analyst out there, according to Walt Deemer. I tweeted Walt, and he said, "Oh, I knew Stan. He was the most well-known, unknown person." But Stan Burge he was out of GE. And he had a great, really the first macroeconomic, monetary, and technical research product. And my father carried his suitcases for about 12 years. And they provided, his research to Provident National Bank, Dr. Ellis, where some greats have come from in technical analysis and just fundamental analysis. Really, Stan Druckenmiller came out of Dr. Ellis, and Stan Burge's work. My father provided Stan's research to Dr. Ellis at Pittsburgh National Bank. So some great stories of the origination as before Stan went on to Soros. And just all these greats that have come before us that my father kind of crossed paths with. And then right before the 87 crash, he partnered up with Mark Chaikin. Now, Mark was the head of the options department at Tucker and then went on to Drexel. And my father was still at Tucker. And Mark introduced my father really to what he called money flow analysis. And it was via a software program by the name of Bill Schmidt. He had a TigerSoft software. It was really one of the first computer systems out there. And my father got it on his desk in 1985. I'll never forget it. I was 10 years old and I took the train in from Chestnut Hill, Philadelphia by myself to check out this computer system. And it was really cool. And on there, he had TigerSoft, which Mark told him to get. And my father fell in love with it. I mean, they were paying a lot of money, I think, per stock to get a historical chart on one company. I think it was $1,000 just for one chart for about 10 years worth of data. And he tells a great story that his assistant at the time reformatted one of his disks and wiped out about 15, 20 stocks. And by accident hit the wrong button, and some of the crazy things that happened back in the day.
That's a very different type of fat finger type of dynamic.
It really is.
When you do it with data.
It puts everything in perspective of where we are today. And it was really interesting. He loved it. And he said, you know, he was an institutional sales guy and he had all the accounts for Tucker, a lot of great accounts in Philadelphia. And he said, you know what, we can put this computer system on every portfolio manager's desk and make it idiot proof. And, you know, we'll have all the F keys preset so they can look at every chart. And that was the beginning of what they called BOMAR, Bob and Mark. They created a software company. And Mark was genius and still is to this day. And my father, you know, was lightning strike between my father and Mark. My father had the accounts and the sales side, and Mark had the technical side and the knowledge, the great knowledge. And the two created, you know, greatness together. And Mark had his two sons. I only know via secondhand story, but they were at Brown and cognitive science majors. And so timing in, you know, as they say, luck is, you know, when preparation meets opportunity. They were prepared and they had opportunity. They got lucky in right place, right time. And Mark's kids were writing code and they became one of the first 100 beta sites of Microsoft Windows because they were cognitive science and Brown. And they wrote the code and it just, everything came together. And then Mark was obviously, you know, a great businessman looking for, you know, what could they do with this? And they it came across Instanet, and which was a Reuters company at the time, and they needed a front end because Mark and Dad, they created the first window-based dynamically update live computer system. It was the first live financial industry. You know, they even sat down, I think Mark sat down with Mike Bloomberg as well, but they were hardwired, so they didn't want software because software is riddled with, you know, viruses. But it was really interesting because they were way ahead of their time in, you know, in timing and positioning. And then, you know, Instant bought my father and Mark's company as their front end to their software known as the Instant RNA system. And that was the history. And Mark has gone on and done greatness since then, coming out of retirement, creating Chaikin Analytics. But I always think of, you know, I'm connected to the original greatness that Mark and my dad had. And it's kind of what I've inherited is the knowledge of really money flow and analyzing the stock market via technical analysis. You know, being a second generation technician, you know, just being, you know, privileged in that sense of where I'm, you know, being born to my father. And it's fascinating. I've become a great historian and practitioner of technical analysis. I love it. It's, you know, as my father says, there's not a dull moment in the stock market. We wake up every day, roll out of bed, excited to find out what's going to happen today, you know. And money flow is really what my father fell in love with, what Mark introduced him to. And it's because it's simple and easy to understand. It's logical and intuitive, all meaning the same thing. And it's work done by, you know, many people in the 80s were working on this. I don't think there was, you know, it's hard to say who created what. They were all working on derivatives. They all, you know, Joseph Granville really was the beginning of it. He started it all, and great stories about Joseph Granville in Atlantic City walking on water. He came out as Moses with the tablet of the 10 Commandments, and he played the piano and he played bag holder blues. And there's just some great stories you hear about things that happened in the 60s and 70s in the, you know, in the beginning of the whole technical analysis movement, it was still done behind closed doors. And but now it's out in the open and known as to be blended with fundamentals. A perfect analyst is both fundamental and technical, encompassing everything holistically. And so Joe really started it. He started a revolution, and he had groupies that followed him around, And then I found Mark talks about all the history, but David Bastian was one that's fallen through the cracks of history. Well, I have a fax from, back in the late 90s that my father had in his old 1968 Dean Witter book of the intensity index by David Bastian. And he really kind of was the creator of a lot of the accumulation distribution, where I believe, was the creator of the accumulation distribution line. And Mark made tweaks to it. And a guy by the name of Bill Schmidt made tweaks to it. And Larry Williams made tweaks to it. And Don Warden, who's did a great article for the CMT back in 2014 before he passed on. God rest his soul. His son, Chris Warden, runs a great software system, the TC2000, which is really awesome. And Don did some work with MoneyStream, which is similar to what Williams was doing, and Schmidt and Chase and Bastian. And they're all, in the 80s trying to find an edge, tweaking. And the theory really is looking at closing strength. Is really the simple analysis of the accumulation distribution. It's where are stocks closing every day? As a lot of technicians always say, the closing price is what pays. And, the closing price is the only financial, data point that's not revised. All these sayings that are true, I assume. But we're measuring closing strength. And my father, Mark, used to call it smart money. And they put the system on Fidelity's desk and all the desks, all the great institutionals, Steinhardt and Tudor and Cohen and Cooperman, all the great guys out there had the Instinet system on their desk, and we're following, trying to learn technicals. And money flow is really it's really looking under the hood of price, accumulation, distribution, and closing strength. And the old adage, smart money's in the morning, dumb money's in the closing. They say the last half hour or the last hour is the smart, most important hour of the day. And it's really because that's when we find out what the closing price is.
There's a lot of things you said I want to just kind of branch off of before we get too deep into the money flow side. First of all, you and I have some parallels. So like you, my father was in the business. He had worked, actually, my father, on Bob Farrell's team. You mentioned Stan Druckenmiller. Stan Druckenmiller was actually a client of my father when he had a hedge fund in 2000 to 2005 or so. So I know a lot about the word you use, which is legacy, when it comes to a family business. Now, my father passed away in 2008, and I tend to, I think with hindsight, I assimilate a lot of the views of my father in my work, but I think forged my own path, much more rules-based, quant-driven, back-tested, as opposed to, the way kind of my father would look at markets using more traditional classic technical analysis. I'm curious for you, just given the family history, how do you differentiate from what's in the blood, right, in terms of the way that you look at markets? Because presumably you've got your own different ways of analyzing than your father or other members of the family.
Wow, that's a powerful question. And I wanted to ask you about your father, because I remember the first time I followed your blog, you showed a video, and I believe it was your father, and you showed it again yesterday, teaching a class. And I was always fascinated by it. So thank you for enlightening me on your history. And it is amazing. Legacy and family is amazing. Yeah, I mean, we're all different. We all have different ways we're all different people, and we have different views and different ways we look at things. My father is old school. He comes from a lot of bear markets, as we all do now. My father would always say, I've been through a lot of bear markets. And now, after doing this for 20 years, I'm like, well, I've been through as many bear markets as you, Dad. You've only been through one more. He loves momentum. He's a momentum investor. He buys high, sells higher, as great traders have proven to be wonderful methodology. And there's a lot of ways to do this. I always say there's really, a lot of ways. I break it down into two buckets. There's buy high, sell higher, and there's buy low, sell high. And, the buy high, sell higher is really the momentum growth strategy of, buying what works, buy 52-week highs. Why are they 52-week highs? Because they're perceived by the market to have good fundamentals, be good companies, and making money. So let's do what's working today. And that's my father's methodology. And it's proven from a trading perspective. He's been running a model portfolio for decades and has proven that to be a great strategy. And many quants and many technicians ever since have proven that momentum, and I've learned early on that momentum is a great strategy. One of the best investment strategies there is momentum. And a lot of people say it's because the market goes up most of the time, and which is true. But my personality, I like to buy low, sell high. I like to buy stocks that have been beaten up, that are quite honestly making relative 52-week lows. And my father would never touch such a stock ever. It's heresy. And to this today, I tried for 20 years to get him to do that. And he's a left-handed Irishman, red-headed Irish. He's so disciplined, very headstrong, very strong. He's in his ways, stuck in his ways as we all are to an extent. But it works. So I'm not there to change him. But my methodology is more to look at what's been underperforming and what's going to start maybe being the next great outperformer. And what's interesting about money flow is that it's not perfectly correlated with price. Accumulation distribution is the primary indicator created by Boston. And we track that first derivative, that indicator. And what's great about it is it doesn't take into account net price change from day to day, like a typical rate of change or momentum indicator. It looks at a closing stock, where a stock closes or an instrument closes every day in a bell jar. So you can have a stock go down from yesterday to today, but close today at the high of the day, still down from yesterday. And because it's 100% above the midpoint, we're going to record 100% positive money flow for the day, even though it's down from yesterday. So, and the opposite, you can have a stock, up from the day before, but close at the bottom end of the range, go out at the low of the day, still above yesterday's close, and we're going to record that as negative money flow. So money flow is kind of special because it looks at closing strength. And so we use money flow. My father loves positive money flow, positive relative performance. We use relative performance, relative strength like everyone else. Jesse Livermore was using it. Everybody was using it. Buy stocks that are going up faster than the market. Sell stocks that are going down faster than the market, or sell stocks that are not going up as much as the market. So relative strength, relative performance is extremely important and is part of our process. As every technician uses it, we don't want to live in a vacuum. However, our little edge is probably not little anymore now that I'm publicizing, but everybody kind of knows this. It's very interesting. Is that money flow is, as I said, not perfectly correlated with price. So we can have positive money flow on stocks that are at 52-week lows on a relative performance basis. And I love that because it's telling me a stock is underperforming or going down in absolute price, but it's closing strong. And that tells me that shorts are, the targets are being met on the short side, profits are being taken on the short side, and new longs are being made on the long side by value buyers. And we work with a lot of value buyers and we work with growth buyers. So we work with, investors who want to buy high, sell higher, and investors who want to buy low, sell high. So it's really, I love that because money flow can be applied to both strategies and really, which brings about diversification. I mean, diversification really is using non-correlated assets, using non-correlated indicators is diversification. And so money flow is great because we can diversify using that. And I found most recently, we use Portfolio 123 as a great software system. I've been out there for probably about 10, 15 years. Introduced to me by Mark. Mark has really taught me. He's been a great mentor over the years. And so I use that as a backtesting engine. It's really a great software to connect into FactSet and S&P Global. So they have no survivorship bias in their software, and it's got every fundamental and technical indicator in it. And we build our money flows into it with different derivatives, and found that really, and doing backtesting, because back in the day, backtesting when I first joined with my dad, it was like, do you have any backtesting? Well, you really needed a lot of money to do backtesting because it was really time intensive. And to this day and age, there's software right off the shelf that you can use. I'm sure there's others many that I don't even know about.
I will say real quick about the current environment. So yes, it's easier to backtest, but I don't find that many people, at least on FinTwit, on Twitter, even advisors, individuals, outside of social media. I don't find many people do it, even though the accessibility with which people can actually see if what they're saying has predictive power has never been as prevalent, right? I'm always amazed how people can test their theories but never seem to want to.
Yeah, I think it's the old adage, you're afraid to find out the truth. You may not want to know that it doesn't work. But I remember, I forget who it was that said it, and it was a great investor, said that this investor really enjoyed using indicators that didn't backtest well because people just disregarded them. And so they threw them to the side when actually there was periods of times when those bad indicators actually worked really well. So, backtesting, as we all know, is full of biases and all sorts of stuff. So it just gives you a general perspective of what maybe to expect. And what I found recently in our testing of money flow with relative performance is it's a momentum model. So money flow is price-based, relative is price-based. And if both are in agreement, you have really strong momentum. And then if money flow is positive and relative performance is negative, you have value. And so in a real strong momentum, every kind of momentum is similar. It falls under that momentum bucket. And momentum typically works in trending markets. It usually works when you have a prevailing trend. The market's above the 200-day, the market's above the 50-day, market's above the 20-day. You really got a good bull market or bear market. And that's when momentum seems to work historically. Not always. There's no panacea here, but generally speaking. And then we have our value model where we use money flow with negative relative performance. And in history, I found that typically works in non-trending markets. When you go into a 52-week low, usually coming out of a 52-week low, the value will work. That is, the old adage, it's a crap rally. You got to buy the crap, and everybody always says that. And that is always what they say coming off a bottom because everything's negative. When you go into a major bottom, you've got 10% of the market above the 200-day. You've got 90% of the market below the 200-day. They're all beat up. Even, the greatest fundamental companies usually get taken down as well. So they call it, everybody's got to buy the junk rally. And in that money flow, we can pick up accumulation on stocks that have been underperforming. And for us, there was an old adage, Mark, my father used to say, smart money. And then I said, money flow is really identifying fundamentals is what my father taught me. And after they sold the firm, my father he ran a market neutral hedge fund for a year with his own money. And then he got cold feet because his partner left. So he went back to research. But during that period of time, he ran a market neutral hedge fund using Zach's earnings revision, earnings surprise model blended with money flow. And the theory was that, earnings revision, earnings surprise would be the fundamentals, money flow would be the momentum. But really what he was doing, looking back on it, and I've tested that strategy ever since, is that both were identifying fundamentals. Money flow, what my father found was that money flow, typically stocks that have positive money flow, closing strong day after day, persistency of money flow, which was one of my father's discoveries, which is a trending of money flow versus a moving average. He found that stocks that are persistently closing strong, they were closing strong for a reason. They had good fundamentals. And they typically went on and had positive earnings revision, earnings surprise. And so my father found that, and this is in 93, 94, was a sideways market. I told my father if he kept the hedge fund open for one more year, we'd be living on a yacht. But he had to close it right. 94 was a tough year. 94, 95 was a tough year. And so, but he found that money flow actually predicted earnings revision, earnings surprise. And stocks that were well bid, they're well bid for a reason because they're good fundamental companies. They typically had positive earnings revision, earnings surprise. So money flow for us really, we use it to identify a good fundamental company. And then we use relative performance to identify a good stock. The old adage, there's a good company and a good stock. Money flow for us helps us identify a good company, generally speaking, because we don't know everything. And then relative performance identifies a good stock. And so that's really the bottom up. We do bottom up analysis. We have a software program. We teamed up with eSignal about 10 years ago, which is owned by ICE. And we built our analytics into that software, ranking and screening every stock in the whole world. based upon money flow and relative performance ranking, and help our clients. We work with about 60 institutional clients and help them identify where the accumulation pattern is in the equity markets around the world. And then my father discovered in the year 2000 the breadth of money flow. He called the top in February 2000. It's a great story. When I joined him, he got up on a dais at Emerald Asset Management. A friend of his, Joe Bessiger, a small cap growth fund out of PA. In year 2000, he had all the technology companies there. And Warren Musser and Bob Musser, who were the head of Safeguard Scientific, which is a mini CMGI at the time. And they had all the technology guys. They're all, I think Bob and Warren Musser were billionaires at the time. And they had all the technology companies at the presentation. And my father got up there with the projector, the glass, the overhead projector. And he told Joe, he said, Joe, you don't want me to get up there. He said, I got no positive money flows on anything. You don't want me up there. And he said, Bob, get up there. We're going to show there's a wall between research and our investment decisions. And so he got up there and he literally thought they were going to throw fruit at him because he had nothing but negative things to say about the market. February of 2000, market went on then and peaked soon thereafter and had a major decline. And that was, in my eyes, when I joined him in 2002, was the greatest story ever told or never told. And from that came the breadth of money flow. He was measuring the percentage of stocks in the NASDAQ that had positive money flow. And so I said, well, we got to make this indicator, Dad. He goes, all right, do whatever you want, And so I took it under my wing to create this, and I did it by hand for many years, and then built it. AIQ was an old system that we used that we built it into, and then years thereafter, many systems we've created it in. Most recently, the TC2000 is a great system for creating breadth indicators. And so that really has been what we use now as a macro timing. A lot like the percentage of stocks above the 200-day moving average, or even the bullish percent index, by Dorsey Wright, which is very similar to percentage of stocks above a 40-day. All of these, are breadth measurements to see how many stocks are in a positive trend or negative trend. And then so we do that with money flow. And what it ends up being is it's not perfectly correlated with price. So like what we've seen since July last year, we've had a huge amount of closing strength in this equity market since July of last year. And we had the great July run last year with a Zweig thrust. And then we had a great run in January with another Zweig thrust. And closing strength has been very strong. And on the high beta index today, we have about 80, I'll tell you right now as I'm running it, 81% of the high beta index with positive money flows, 65% of the high beta index versus low volatility with positive relative performance above the 200-day. So there's been still a really tremendous amount of accumulation since the June, July lows of last year, which turned our model. We run a macro model, really risk on, risk off model, cyclical, non-cyclical model based upon the money flow breadth, which is liquidity. We're measuring liquidity. Stocks closing strong means money's flowing into the market. Stocks closing weak means money's flowing out of the market. And I did a presentation at the CMT conference in 2019 about this. And really, liquidity is the key. So we measure, all the market caps from mega cap, large cap, mid cap, small cap. And as you go down the market cap, as you would expect, the volatility picks up because the liquidity diminishes. And the spread between the bid and the ask gets wider. So we concentrate our efforts on the deep end of the pool where the liquidity lies within the Dow, the OEX 100, and even the S&P 500, and keep a finger on the pulse of the market to see, are the majority of stocks in the market closing strong? Yeah, they may not be going up or going down, but are they closing strong? And that tells us that at least there's a bid to the market.
But hold on that point. That goes directly to breadth. We're talking about closing strong versus closing weak.
Yes.
Yeah, I just put out that tweet as we were chatting, just noting that retailers, for example, XRT as the ETF proxy, which as I recall is equal weight, is at new lows for the year, and a lot of small caps keep on having these kind of fits and starts, but the underperformance is very real against large caps. You had mentioned that your style is much more buying lows. There's been interesting money out of defensive sectors like utilities and staples the last couple of weeks, but it's one of those things where I'd argue it's a confused market, but maybe one that's still set up for some high risk, purely from the standpoint that It looks like there's defensive capitulation. At the same time that small caps may want to break their lows, at the same time that consumer stocks are pretty weak. So when you think about it from a money flow perspective, from a short term basis, how do you interpret what's happening? Entering the summer period here, because I think a lot of people are arguing we are still in a melt up. A lot of things are not, I would argue, going to historical script, especially in a pre-election year.
Yeah. And you're absolutely correct in all your observations. So our model turned positive in July of last year when it was nasty. And our models had a great track record. We went bearish before COVID. We went bearish last year in November, December of 2021. So, out of the past 3 years, we've got 2 out of 3 calls. Absolutely, the model has gotten them correct. So, but it was incorrect in 2021. So, there's no panacea in what we do. We don't know the future, but it just gives us a pulse as to what's going on. And most recently, so our model's been bullish since July of last year. So we're 10 months bullish now, owning cyclicals. And when I'm bullish, I want to own high beta, economically sensitive. And I classify simply as a basket of cyclicals, which is the 6 sectors I call them, which are financials, industrials, materials, energy, discretionary technology, equally weighted. We equal weight everything because I can't cherry pick. I don't know. I'm not going to try because I'll get it wrong. So I just buy generally everything that's typically high beta, economically sensitive. And, so I love small caps, mid caps, international, emerging, whatever has a high beta, I love when I'm bullish. And then when the model goes bearish, which happens over the past 23 years, once every 12 months. We've had nothing but crisis every 12 months for the past 10 plus 15 years. Every 12 months, there's a crisis. So the model, only stays positive for about 12 months on average. The past 2 years, it's been 200% turnover. So the volatility has been greater over the past 2 years on our model because we've been in a 100-year pandemic. The market's been in a bit of a heart attack, but we've still been able to be 2 out of 3 calls in the past 3 years have been on the right side of the market, which has been good. Now let's address what you're saying now. So I am for the first time picking up negative divergence on our money flow breadth. And it's mild divergence. And there's the old saying that all tops have divergences, but not all divergences call tops. Well, that is true of our money flows because we're price-based. We're a momentum indicator. So we are a cousin of price. Money flow is a cousin of price. So yeah, we've got divergence right now. So I'm concerned, but our model hasn't gone negative. So I'm watching it. And, the bear camp could play out here. We haven't gotten the signal yet to go defensive, simply stated.
And do you factor in any kind of cycle work in terms of, where we are seasonality wise or in the presidential cycle? Again, I go back to this. There's some dynamics which are odd here. And I'm with you. It doesn't seem like it's a very sudden type of abrupt stop, right? But a lot of the stuff I'm seeing would suggest that we've already kind of been in a correction, just not one that you can easily identify looking at the large cap averages.
Yeah, we just follow the money flows. I don't get into all the other different disciplines. I follow the relative performance, and really just key off money flows because it's the only thing that I can really understand and that I have tested and what our specialty is in the marketplace. In history, our model turns gears once a year. So we're 10 months into being bullish. So we are getting a little long in the tooth from a historical basis of our model. And so that's kind of important because nothing lasts forever. And this too will change. We've been bullish since July, and it kind of reminds me of the cousin Vinny market where, he's stuck in the mud, spinning his tires. I kind of feel like I'm looking for a positive outcome here and a blow off. And because I'm bullish and I'm talking my book and I'm looking for the best for that. But at the end of the day, if the money flows go negative, we're going to change our position. And one of my thoughts is that, all of this accumulation that we've seen since July and last year could lead to a quick blow off short covering rally that pushes the market back to prior highs, which is not too far away. It's just about 8% or so on the high beta index. It's 12% on the S&P 500, but it's really not that far on the mega cap markets. So maybe there's that. And then into that blow off, I pick up continued negative money flow, and the money flows go negative as the market blows off. That's kind of what I'm thinking, because money flow breadth typically goes negative before the market breaks. It's typically a lead indicator. And that's why my father's always loved it, Mark, and everybody's always loved money flow, because it typically is non-confirming. It'll give you divergence. It'll go negative before price does, or it'll go positive before price does. And so, and then when you look at the breadth and you look at the group as a whole from an equal weighted perspective, it behaves like that as well. So, we've nailed every top in the past 20 years because money flow typically goes negative before the market does. And one of the great attributes of our model is reducing risk. Technical analysis has been proven by many that the great attributes of technical analysis is risk management. It avoids excessive drawdown. And that's why technical analysis has been so absorbed by the marketplace over the past 10, 15 years, because we've had so many drawdown events. I mean, just in the past 5 years, we've had three 20% corrections. And the frequency of that is, once you typically have a 20% correction every, 10 years or something. So the fact that we've had 3 in the past 5, volatility is very difficult. And so technical analysis is good to help avoid excessive drawdown. And our money flows do just that. They help. They're not perfect, but they're right more than they're wrong. And so I'm getting a little divergence in here, which says, okay, there's some profit taking, but maybe we get one last blow off and the money flows stay negative, and then we go, the model goes negative. That would be best case scenario. Otherwise, it all just goes negative together. Money flows can be coincident at times with price if it's powerful enough. So it'll be interesting. I publish a daily market letter every day talking about the money flow breadth on the markets. And we do that for our clients every day. I run a video blog, and we have a software program we put on our clients' desks to help them. We teach our clients how to be technical analysts. The old adage, give a man a fish, he eats for a day, or teach him to fish and he eats for a lifetime. And we're consultants. That's what we do. We teach, professional money managers about money flow analysis and, help incorporate that into their mosaic of information.
Yeah, which I give you a lot of credit for. It's not easy to do that, especially in sort of a more niche type of way of looking at markets. What are some of the typical lag times? So once money flow starts changing, I understand the coincident point, but when it is leading, is there a typical time frame of lag? Meaning, is it a month, 3 months, 6 months, or does it vary really across the board?
Yeah, it's usually with it could be as short as a month, but it usually gives us a couple weeks to a month to a couple months. It gives us enough time to get out. I mean, that's really, if, for instance, last year or 2021, it went bearish in December of 21. The market didn't break until February. So, and then even with the COVID crash, which was very interesting, our model went bearish again in December, January, and the COVID crash didn't come until February, the end of February. So, we move when it tells us to move, and we don't know if we're right or wrong. We just follow a very disciplined approach. I'm a redheaded Irishman, so I'm very emotional and crazy and loud, and so I'm like the opposite of the personality that you would use for investing. And that's why, and my father, the same thing. And that's why I think he loved technical analysis, because we were able to create a systematic, repeatable process that took the human out of it, made it extremely objective. And that's what we do. We just follow the money flows and run a disciplined model and do what it tells us to do. And we found in history that it's, more right than wrong. And the greatest attribute of what we do is really not losing the money. I mean, over the past 20 years, our cyclical, non-cyclical model has tripled the performance of the S&P with half the drawdown. And it's in half the drawdown where we get a lot of our alpha. It's like, Warren Buffett always said, rule number 1, don't lose the money. Rule number 2, don't forget rule number 1. That's what our model and technical analysis in general, that's like the basis of what we do. Don't lose the money. And there's always time to make hay. The sun will always shine. Again, it's just when it's rainy out there, let's be careful. Right now, everything's okay, but it's getting a little long in the tooth is what it really looks like. I'd love to see it break out to the upside and defy all the naysayers. because that's just how I'm positioned right now. But I know that, anything can happen. So we don't get dogmatic and stuck into a perspective. We let the model tell us what to do.
Do you find that for those clients that see your work when it's changing, right, that would suggest you're either at a low or a high and that you're about to reverse, do you find that some of those clients give pushback even though they trust your work and analysis? I say that only because I've experienced that myself when it comes to subscribers. I've talked to David Rosenberg, who's made that observation before, that if you start loudly going against the current narrative, you can be more confident that you're probably right when those that are actually paying for your work are going out of their way to counter your conclusion.
It's amazing. I was a psychology major in college. My mother was a clinical psychologist, father a technical analyst. My brother's got his master's in clinical psychology as a behavioral finance at PNC. And psychology is a big part of this. And it's hard. Everybody has an opinion. Every one of our clients are trained professionals. They have, formulated models that they've created throughout their career and that they run vigorously. And, it's really, as my father would say, somebody has to be with you for a couple cycles to see you and how your calls are before they'll believe you. And it's really, almost, even then they may not believe you. So we just do what we do. We're just another data point in the mosaic of our clients' models. And really, we fall under that sentiment, factor within our clients' models. More now today is wonderful is because of computer systems, of what Mark and Dad did in creating the first window-based live dynamically updating system sold to Reuters in 92, 30 plus years ago. Now computer system, charts and technical analysis are ubiquitous across everybody's computer and iPhone and watch, for God's sakes. So technical analysis has become more mainstream, which is wonderful. And so it's my dad, the old stories of Dad and Mark, they would say, and all the great ones before us that, they close the door and then they pull out the chart book from literally the top drawer. That was just an absolute truism. Today, technical analysis is embraced as a risk management strategy across all disciplines, and it's wonderful. And for that matter, it's made my job a lot easier. People, when I first started with my dad, we'd be all you do is cold call. We're the old-fashioned cold callers. And they'd be like, oh, you're just a momentum model. Oh, you're a technical analysis? Click. Okay, this is a hell of a business you got us into, Dad. They won't take our call. But today they take our call, which is great. And it makes it a little bit easier. And, maybe it's self-fulfilling. The old self-fulfilling prophecy when everybody's doing this, gets the whisper down the lane. And that may be true, but more information is the key. The more information you have, the better you are informed to make a good decision. And we're just here to add as much information to our clients as we can. They're the smartest people in the world. I mean, every one of our clients are geniuses, a lot smarter than me. That's for damn sure. So, and I listen to my clients too. My clients say something, I'm like, okay, well, maybe I'll, rethink this. But we can't change our clients. We just add information to them and help them in any way we can. I find a lot of times, they just do what they feel is right. And for compliance purposes, and they don't tell me anything. So clients really, they're not allowed to disclose, and they rarely do really disclose what they're doing, for their own, purposes. They keep everything very secretive.
Yeah, and I also find that people may agree or disagree, but the question is, will they actually act on anything? That's always on them, as you know,
Yes.
right? It's so I find a lot of people will say things, but actions just don't follow through, no matter what they're saying or expressing. Because it's a lot easier to talk than to trade, which I think is the case across the board. For those that are in the audience that are curious about taking a deeper dive in your research, where do people find some of your work, Terrence, and what are some of the suggestions you have for those that want to learn more about money flow?
Yeah, our homepage at Brogan Group Research is a great place to find us, and they can email me at tbrogan@Wellington Shields anytime, and can put you on distribution for a trial for our research. And we provide our research to everybody the same. It's just, based on, how big they are, how small they are, everybody gets the same research. And we just, we just have a different way of looking at things. And, it's not perfect. There's no panacea, but it's right more than it's wrong. And it's just, we love it. We're huge fans of money flow analysis. And it's kind of a truth telling. It looks inside price because we all know what price is doing. It's just, do we really know? Is price maybe going up, but is it closing strong? That old closing strong method is a very important perspective to the markets. And, it's very similar to, open interest. They would, open interest is high as if they're keeping, holding overnight positions. And if they're holding overnight positions, then they're positive that, it's not going to blow up tomorrow. It's kind of a similar perspective when looking at money flows within the marketplace. So we're positive for now. We're hoping good things to come. I hope the divergence that I'm seeing right now gets broken out of. But, this too may change. We're going to keep a close eye on it.
It's a good place to wrap this Twitter space up. Everybody, please make sure you follow Terrence Brogan. Thank you, Terrence. Appreciate it.
Yes, Michael, it was an absolute pleasure. Thank you.